Recently, I got a lot of inquiry asking, "Hey Thomas, what should I do if there's a huge tax bill coming up?" Maybe you sold your cottage or your rental properties, or you let go your stocks or crypto. You're happily enjoying your profit until you realize with huge capital gain also comes with a hefty tax bill. And by April, that CRA is ready to share your profit too. So how do you calculate the capital gain tax? And what can we do to keep as much money as possible? So in this video, I want to share 6 strategies that can offset capital gain tax so you can save tens of thousands of dollars. And before we start, if this is your first time here, thanks for dropping by. My name is Thomas. This channel is to help Canadians to make better choices on retirement, wealth, and insurance. My goal is to make sure you can take 1 or 2 ideas home and start making better financial decisions today. So if you find this video valuable, make sure you click the subscribe button below. Let's get started. Let's first have a look at how high capital gain tax is. In Canada, if you make any profit on an investment, 50% of the growth will be considered as capital gain. So say if you bought your second property at $500,000 10 years ago and now you sell it at $1.5 million, the $1 million will become your profit, and 50%, which is $500,000 of that, will be capital gain and considered as your income that year. And that pretty much pushes you to the highest tax bracket, and depends which province you're in, you will need to pay give and take $250,000 to our Canadian government. Paying 25% tax isn't fun, so let's have a look at the 6 strategies you can use to offset your capital gain tax. I will first introduce the easiest way, then I will move to a more complex strategy. And as a disclaimer, this video is for information purpose. Whether any of the strategy fits you or not, please talk to a tax specialist or financial advisor. Yes, the first and the most effective strategy to offset capital gain tax is simply your timing. If you sell a property or shares, time the sale as early as in the calendar year as possible. The best timing would be the first 2 months of the year, because then you have time for the next 14 months until April of the next year to figure out the tax problem. So for example, if you sold a property or shares in January 2021, you have time until April 2022 to figure out the whole tax situation. But if you were to do it in December 2021, you also have to pay the tax in April 2022, which is significantly less time. So plan and time your capital gain as much as possible. The next strategy to offset huge capital gain tax is leveraging capital loss. This means that you use the loss to even out the capital gain. And here's an example. Let's say in the year 2020, you earned $1,000 profit from selling stock A in a non-registered account. Now, usually you have to pay 50% in the capital gain tax. But let's say in 2020, you also lost $1,000 off selling stock B. In this scenario, the win and the lose cancel each other out and you won't have to pay any capital gain tax. It's also possible to offset a part of the capital gain tax. For example, if you have a capital gain of $1,000 and a loss of $500, so your profit is $500, and assuming you're in 50% tax bracket, which is $250, which is a lot more feasible. If you have a year where you only have losses, you can carry those losses forward or backward to apply them to different years. Carrying it backward is possible for up to 3 years to offset any gains for a tax refund, or carry them forward indefinitely and accumulate them. In most cases, a capital loss can only be used to offset a capital gain, but there are even such incidents where you can claim your capital loss against some kind of income, but you should consult a qualified accountant to discuss this strategy. Now, one important thing to keep in mind is that in order to properly offset capital loss, it has to be a real loss. This means you cannot just sell and repurchase the stocks within a month. What's more, you also cannot sell a stock and then tell your spouse to buy it. Those things are considered superficial losses and they aren't suitable to offset a capital gain. What some people do is sell investments that have decreased in value and then purchase a similar investment. All in all, capital loss is a solid strategy to reduce the tax burden. But what if I don't have any capital loss in my years of investing? Let's have a look at strategy number 3, which is leveraging your RSP. RSP is one of the most popular tax shelter accounts in Canada. While the investment gain pushes your income to the next level, RSP can help offset it by lowering your taxable income. For example, if you bought a place at $500,000 a couple of years ago and you now sell it at $700,000, the capital gain will be $100,000. And if your RSP happens to have a $100,000 room, then you can contribute that $100,000 and your tax will be evened out. Keep in mind, however, that once you take the money out from your RSP, you'll be taxed at your full marginal rate because you did not pay the tax on your income when you contributed, and the room will not be regenerated. Still, it's a good strategy to distribute your capital gain because instead of paying all the taxes in one calendar year, once you put it in RSP, you can choose a longer period to slowly take the money back out. And that's why, for most of the time, I recommended we should contribute to RSP, but don't max out your RSP every single year. You want to save some room for this capital gain scenario. My suggestion is usually leave 30% room every year and carry forward. And if you want to discover more RSP strategies, check out my other videos. I have a whole playlist about RSP and I'm sure you'll find it very valuable. The next thing you can do to offset capital gain tax is to do an investment loan. Under the line 22100, the carrying charge, it's possible to use loans to deduct interest, but that's a requirement. Your loan must be directly involved to produce income. It can be interest, dividends, rents, or business income. There has to be a direct link between the loan and the use of the fund. So for example, you take out the loan and use it to invest in paper assets that pays dividend, then it becomes tax deductible. And there are a few things to consider. First, the money that you borrow must be used for the purpose of earning income from a business or property. Property incomes includes interest income, dividends, rents, and royalties. Employment income doesn't count towards this though. Second, you must pay the interest during the year in which you are claiming the deduction. Note that compounding interest is only deductible in the year it is actually paid. And also, there must be a legal obligation to pay the interest. And let's talk about a couple of things that we need to pay attention. Even though the interest that you borrow is 100% tax deductible and there's no cap like the RSP room, but in the end, this is still a borrow to invest strategy, meaning your returns need to be better than the cost of borrowing. Say your interest payment is at 3%, then you want to aim for at least 5% real return for the investment. And depends on what loan you borrow, it might reflect on your credit reports. And I have a detailed video about should you borrow to invest. I will leave the link at the top corner and be sure to check it out. Now, strategy 1 to 4 is relatively simple and require less capital to do it. The following two ways require larger capital in order for the math to make sense, and it's more risk involved, so be sure to talk to a specialist first. Strategy number 5 to offset huge capital gain tax is flow-through shares. What exactly is that? Flow-through shares are a special issue of common shares where the tax deduction are issued to the original investor and then become regular common shares after tax deduction is completed. Okay, what the heck does that mean? In a nutshell, certain sectors in Canada like mining, oil, gas, or renewable energy sectors need funding to grow and develop. So the government wants to encourage investors to support any exchange. The government comes up with a tax incentive called the flow-through share. When you purchase flow-through shares, you'll receive a tax slip from the company allowing you to claim the full purchase price as a deduction on your year-end taxes. And here's an example of what that could look like. For easy numbers, let's say that your annual income is $100,000. And if you invest $10,000 in ABC Mining, you can write off your income by $10,000 and now your income is $90,000. Let's assume you're in the highest tax bracket and your tax would be 50%, so you save $5,000 in tax by lowering $10,000 of taxable income, similar to an RSP in this case. And wait, there's more. You can then sell the shares at $10,000, assuming your investment has neither increased nor decreased in value. Yes, this will create another capital gain of $10,000, which is taxed by 50% on half of the profit, which is about $2,500. So you got $5,000 back from the government, but when you sell and pay a capital gain of $2,500, you still net $2,500 positive. Now, while this strategy is powerful, but it also takes a lot of planning and a good understanding of how the flow-through shares, tax calculation, and a lot more. Also, usually the money needs to stay in the company for at least 2 to 5 years, and worst case scenario, if the company goes bankrupt, the money you invest will become zero. Neither you have done this before or not, please triple check with your specialist. Strategy number 6, Small Business Venture Tax Credit. I'm not sure if every province has this, but I know if you're in BC, you can use this strategy to offset your capital gain tax. Can you let me know in the comments if your province has this too? The Small Business Venture Capital Tax Credit encourages investors to make equity capital investments in BC in order to give small business access to early stage venture capital to help them develop and grow. BC investors receive a 30% tax credit on their investment in a venture capital corporation or an eligible business corporation. I'm not going to talk about the difference between the EBC or the VCC in this video. For your information, as long as they are recognized by the BC government and you can find the list in the program. Let's talk about the features for this strategy. Each individual can invest up to $400,000 annually and receive a 30% refundable tax credit. And the keyword is tax credit, not tax write-off, meaning you can save $120,000 of tax and the credit can be carried forward for up to 4 years. Sounds like a lot of money involved and a lot of tax implication, and it for sure does. And according to research, 50% of all small businesses fail in the first 5 years. And again, your investment can potentially go to zero. So if you really want to do this, talk to a pro who can show you the ropes, as there's a lot that can go wrong. Alright, here are my 6 strategies to offset capital gain taxes in Canada. But wait, I want to throw a bonus to you. This is actually recommended by an accountant friend of mine. He said this is a good strategy, especially if you're selling a business or a property. If the proceeds of depositions from a sale of capital property are not all receivable in the year of sale, the CRA allows a taxpayer to defer a portion of the capital gain within specified limits until the year in which the proceeds become receivable. For example, when you sell a property, you usually have to pay the tax bill in full. However, sometimes you'll receive the amount over a number of years. For example, you might sell a property for $50,000 and receive $10,000 when you sell it and the remaining $40,000 over the next 4 years. There are limitations and restrictions about this rule. The calculation of the reserve is not easy. You should consult a qualified accountant to discuss this strategy. If you guys want to know more in details, please leave a comment below and I will invite my accounting friend to share. So to sum it up, the 7 strategies you can use to offset capital gain tax are timing, capital loss, RRSP, investment loans, flow-through shares, small business venture tax credits, and as a bonus, the capital gain reserve. Some of them are more complex than the others and involve more risk, and that's why I recommended talking to your accountant or a financial advisor ahead of time for better planning and save as much tax as possible. And please share this video to your family and friends who just recently sold their investments or received a huge bonus. Oh, and don't forget to check out this video too. It will help with your tax planning. This is Thomas, and I will see you in the next video.